If you work in tech in California, your equity compensation may be the most powerful and often the most misunderstood part of your compensation. RSUs, ISOs, NSOs, and ESPPs may all look like company stock, but they are not taxed the same way. And sometimes you may end up with a tax bill on income you never actually turned into cash. I experienced this personally during Uber's IPO. This is why equity compensation planning is not just an investment decision. It is also a tax decision, a cash flow decision, a concentration risk decision, and sometimes even a residency planning decision. Your employer may already determine your salary, bonus, benefits, career path, and future equity grants. If a large portion of your portfolio is also tied to your employer stock, your financial life may be more concentrated than it appears. This concentration can work very well when the stock goes up, but it can be painful when the stock falls, layoffs happen, or a tax bill arrives at the wrong time. A good equity compensation plan must answer these 5 questions. First, when does equity become taxable? Second, how much tax should you expect? Third, should you hold, sell, or diversify? Fourth, how will you pay the tax? And finally, how does this fit with your broader portfolio, cash needs, and long-term goals? Hi, I'm Aaratee, founder of Foray Financial. I've spent more than 20 years at the intersection of finance and technology in Silicon Valley, including leadership roles at major tech companies and leading financial institutions. On this channel, I break down practical tax, investing, and wealth management topics for high-income Californians. Today, we are talking about equity compensation planning for California tech employees. We will cover 4 things. First, the 4 most common forms of equity compensation: RSUs, ISOs, NSOs, and ESPPs, and how each one is taxed. Second, why equity compensation planning matters so much in California. Third, how to manage your equity without taking unnecessary tax, cash flow, or concentration risk. And finally, a simple equity planning checklist you can use to make better decisions. If you work in tech in California, your equity compensation can create a bigger tax bill than you expect. Here are 4 reasons why California makes equity compensation planning even more important. First, employer withholding may not match your actual tax bill. For California tech employees in higher tax brackets, the actual marginal tax rate may be higher than the default withholding rate, and this can create a tax gap. RSU vesting, NSO exercises, and certain ESPP events may also create wage income. So payroll taxes matter too. For California employees, that may include Medicare tax, additional Medicare tax, and the uncapped California SDI. The California SDI is especially relevant for high-earning employees because the wage cap was removed beginning in 2024. This means all your wages are now subject to SDI withholding. Second, California does not have a lower tax rate for long-term capital gains. At the state level, all capital gains are generally taxed as ordinary income. So holding your company stock for more than a year can help at the federal level, but it does not create the same state tax benefit. Third, AMT or alternate minimum tax can create a cash flow problem. A big risk with incentive stock options is owing AMT on shares you have not sold. And this can happen with both public and private company shares. So before exercising ISOs, model the federal tax impact, California tax, and California AMT if applicable. Fourth, California may tax a part of equity compensation even after you move out of California. If you receive equity grants while working in California and later move to another state, California may still claim a portion of the income connected to services performed while you lived or worked in California. This is why planning before a move matters. Let's talk about RSUs or restricted stock units. Your RSU withholding may look like taxes were handled, but for many California tech employees, that withholding may not be enough. Now, RSUs are one of the most common forms of compensation at public tech companies. They're generally taxed when they vest. At vesting, the fair market value of the shares is treated as wage income and reported on your W-2. Your employer usually withholds taxes by selling or withholding some of the shares. But RSU withholding can create a false sense of security. Taxes were withheld, but that does not always mean enough taxes were withheld. For federal taxes, supplemental wage withholding is generally 22% up to 1 million in a calendar year and 37% above that level. For California, the default withholding rate for stock options is about 10.2%. For many high-income California tech employees, the actual marginal tax rate may be higher than the default withholding rate. So you may think taxes were handled through payroll, but when April comes, there may still be a large balance due, and in some cases like California, an underpayment penalty. RSUs are also wage income, so payroll taxes matter too. For California employees, that may include Social Security up to the wage base, Medicare tax, additional Medicare, and also the uncapped California SDI. A better approach is not to guess. Run a tax projection during the year and decide whether you need estimated tax payments, additional withholding, or a planned sale of shares to cover the taxes. Once RSUs vest, they are similar to receiving a cash bonus and using that cash to buy your company's stock. You already paid ordinary income tax on the value at vesting. From that point forward, holding your company's stock is an investment decision, not a compensation decision. If you continue holding the shares, any future gain or loss is treated as capital gain or loss when you sell. For example, if 1,000 RSUs vest when the stock is trading at $100, you generally recognize 100,000 of wage income. If you later sell those shares at $130, the additional 30,000 is capital gain. Let's talk about ISOs or incentive stock options. Now, ISOs can create a tax bill even when you do not sell a single share. That surprise comes from AMT or the alternate minimum tax, which is why ISOs are easy to mismanage. Now, here's why people like ISOs. At exercise, there is no regular income tax if you exercise and hold the shares. Now, that sounds great, but the catch is AMT or the alternate minimum tax. The difference between your exercise price and the fair market value at exercise is called the bargain element. This bargain element may be added to your alternate minimum taxable income, which means you may owe tax even though you did not sell the shares and did not receive the cash. For example, assume your exercise price is $10 and the stock is worth $50. The bargain element is $40 per share. If you exercise 10,000 shares, that is 400,000 bargain element that may matter for AMT. This is where ISO planning becomes critical. For California tech employees in higher tax brackets, salary, bonus, RSU, investment income, and ISO exercises can combine together to create a much larger tax bill than expected. We will talk about qualifying and disqualifying dispositions next. Let's talk about qualifying and disqualifying dispositions. With ISOs, the better tax treatment may not always be the better financial decision. To receive a favorable ISO treatment, you generally need to meet two holding period rules: 2 years from the grant date and 1 year from the exercise date. If you sell before meeting these two rules, it is generally called a disqualifying disposition. That may sound bad, but is not always a mistake. Sometimes selling early is a better risk management decision. If you exercise, hold, and the stock falls sharply, you could end up with both a tax problem and a portfolio problem. The same year exercise and sale also avoids the ISO AMT issue since the shares were not held past year end. So the goal is not always to minimize this year's tax bill. A better goal is to maximize after-tax risk-adjusted wealth. With ISOs, model your AMT exposure before exercising. Consider exercising in small chunks and coordinate your decision with your full tax projection. Let's talk about NSOs or non-qualified stock options. NSOs are simpler than ISOs, but they can still create a major cash flow problem. And here's why. NSOs generally have a more direct tax event. When you exercise NSOs, the spread between the fair market value and your exercise price is treated as ordinary wage income. For example, if your exercise price is $20 and the stock is worth $80, the $60 spread is generally taxed as ordinary wage income at exercise. Payroll taxes may also apply, including uncapped California SDI. After exercise, your tax basis is usually the fair market value at exercise. Any future gain or loss after that is treated as capital gain or loss when you sell. Now, NSOs do not create the same AMT surprise as ISOs, so they are simpler from a tax calculation standpoint, but they're not risk-free. Before exercising NSOs, ask yourself these 3 questions. Do I have enough cash to cover both the exercise cost and the taxes? Can I sell shares immediately after exercise? And finally, if this is a private company, am I comfortable owing taxes on shares I may not be able to sell? Let's talk about ESPPs, or employer stock purchase plans. ESPPs can feel like free money, but they also quietly increase your employer stock concentration. That matters even more if you already receive RSUs or options from the same employer. ESPPs allow employees to buy company stock, often at a discount. Some plans also include a look-back feature where the purchase price is based on the lower of the stock price at the beginning or end of the offer period. A 15% discount with a look-back feature can be very attractive, but ESPPs also increase your exposure to employer stock. For qualified ESPPs, you generally do not recognize income when you enroll or when the shares are purchased. The tax treatment is determined when you sell. There are two common approaches. One strategy is to sell shortly after purchase. This may give up some of the favorable federal tax treatment, but it captures a discount and reduces any concentration risk you may have. The second strategy is to hold. This may improve your federal tax treatment, but it also means holding your company stock longer. So set a target limit for how much of your liquid net worth you're comfortable keeping in your company stock. The biggest equity planning mistake is optimizing for taxes while ignoring risk. Do not optimize one piece in isolation. A good equity strategy coordinates 5 dimensions: taxes, diversification, cash flow, concentration risk, and long-term goals. Tax minimization alone can lead to bad decisions. You might hold too much company stock just to delay capital gains. You might exercise too many ISOs in a year when you cannot afford the AMT bill. Or you might hold ESPPs for favorable tax treatment while your employer stock exposure keeps growing. Before any major equity decision, ask yourself these 5 questions. First, what is my employer stock concentration today? Second, what is my marginal tax rate this year and next year? Third, do I have enough cash to pay the tax from this vest, exercise, or sale? Fourth, am I in a qualifying disposition window for any ISO or ESPP shares? In other words, would selling give up favorable tax treatment on these shares? And finally, does this decision move me closer to my long-term goals or further away? Equity compensation can build wealth, but RSUs, ISOs, NSOs, and ESPP each come with different tax, cash flow, and concentration risk. The goal is not just to receive equity. The goal is to turn it into durable, diversified wealth. Here is a quick, practical checklist by equity type. For RSUs, know how much will vest this year, whether withholding will be enough or whether you have a sell-at-vest strategy to cover taxes. For ISOs, model the bargain element, AMT exposure, available cash, and what happens if the stock price falls. For NSOs, understand the ordinary income created at exercise and whether you can sell shares to cover taxes. For ESPPs, know the discount, the look-back feature, your holding period, and whether you're letting employer stock accumulate unintentionally. And across all of these, set a target maximum percentage of your liquid net worth you're comfortable keeping in your employer stock. There is no universal rule that everyone must sell every share at vest, but there should be a plan. Equity compensation can be one of the most powerful wealth-building tools available to a tech employee. But without deliberate planning, you may be relying more on luck than strategy. And remember, a strong equity compensation plan is not simply about minimizing taxes. It is about coordinating taxes, investments, cash flow, concentration risk, and your long-term goals. For California tech employees, this coordination matters even more because California taxes can meaningfully change the after-tax outcome. If you found this helpful, please subscribe for more videos on tax-efficient investing, cash management, and tax planning for Californians. And if you need help thinking through your own cash management, tax management, and portfolio management, you can learn more on our website, auraefinancial.com. Thank you for watching, and I'll see you in the next video.